Um, one more time. Topic of this seminar is no risk real estate investment. This is how to do it. Let me introduce myself. I am the speaker of today's meeting. I'm the founder and CEO of Nihongo-de-USA. I was born and raised in Tokyo, and right now lives in Clintonville with my husband from Michigan and two sons, 10 and 15-year-olds, and a black cat, an OSU student from Japan, and an Airbnb tenant. History in the US. When I was 20, now you can tell how old I am. I came to West Coast first and went to college, and I studied abroad for 1 year. And then later in 1998 to 2005, I spent my time on East Coast, first in a suburb of Boston in West Concord and Mid-Hudson Valley area in New York, and then Wilmington in North Carolina. And then I went back to Japan and spent 5.5 years in Tokyo. That's my hometown. And then I came back to Columbus, came to Columbus in 2010, and I still live here. My work history, when I was in college in Japan in 1990, I started my first business, which was a communication training in market entry consultation in Tokyo. In 2010, I moved to Columbus, started a homestay business, and bought a property, 4-unit apartment property, and started the property management company. And then later, I got licensed to be a realtor in 2011 and started the Nihongo de Columbus. That's the former name of current Nihongo de USA. My real estate investment has started in 2010. When I first moved here, I purchased a 4-unit apartment building that burned down. And luckily, the insurance payment from that building and proceeds of the sale of the land became down payment for the first home that I purchased in Dublin for the expat family. 2011, I purchased a single family home. That's where we live with a family and run a homestay business and Airbnb. From 2012 to 2021, purchased 10 single family homes, and we still hold 9 properties, 6 in Dublin City School in Ohio, 1 in Fort Wayne, Indiana, 1 in Madison City School District in Alabama, 1 in Elizabethtown, Kentucky. And then this year, we purchased 1 home and fixed it up and sold it 2 months later. That was in Columbus, Ohio. That was right behind the Riverside Hospital. My hobby is traveling the world with my family and try something new. If I've never done it, if somebody asks to do it, I'm happy to do that. And I still cannot ride a bike as of today. Okay, no risk real estate investment. So I am going to go over how to do a real estate investment without any risks. There are 4 main points. 1, aim for capital gain, not for income gain in the beginning. I'll explain why later. And do not worry, I'm not saying you can't go after income gain. Income gain grows over the time along with capital gain, so you'll get that too. 2, property value does not go up if you keep it vacant, so keep it rented. 3, make mortgage payment and repair costs with the rent from your tenant. You do not have to spend your own money more than the money you're spending to purchase. Make sure you keep it rented, so therefore your tenant is paying off your mortgage and paying for the repair cost. In short, it is a gain to hold properties until they appreciate by paying off mortgage and keeping the properties in shape using tenants' rent payment. If you do that enough, then your children do not have to work for food. 4, own 4 properties as quickly as you can. That would create less stress because not all 4 homes become vacant all at once, and rent income from 3 homes should pay for the 4 mortgages. And I'll explain that a little more later. First, why do properties keep appreciating in value? Some of you might have wondered about that because that's not always true in other countries other than US. Like Japan, you purchase property, it's just like a car. Next day, the price drops and it never appreciates back unless it's a limited, some kind of properties. Here, most of the property appreciate. This is the reason why. Undersupply of new built homes after the last recession caused lack of inventory homes in United States. So you can see that Lehman shock happened. And then after that, new built homes are undersupply. While the population has grown, but not the number of the homes. So that created the low inventory. So these are the inventory homes. Inventory homes are reduced to half from the time of recession. You see the graph? So while inventory, which means for sale homes, whether it's existent or brand new, is being low, the people are coming in to live in United States or in your local area. Imminently, if there's lack of supply, the price goes up. So while that property value keep going up, these rules apply for what I say about no risk real estate investment. First, aim for capital gain, not for income gain in the beginning. So these are the numbers of the 8 homes I purchased over 8 years. 6 in Dublin City School, 1 in Fort Wayne, 1 in Madison City School. I purchased more later, but these are the numbers with 8 homes. You can see the capital gain and income gain in here. The first number, 1.734425, is the total of 8 of the purchase prices of those homes. $395,000, $741 is how much I spend for down payment and closing cost total. And in August of 2020, if I sold those 8 homes, 2.28 was the price. As a real estate agent, I was very confident to sell those homes at that price. At that time, loan balance was 1.25 million. That means that market price minus loan balance will be the equity that I own. So that went over $1 million. A lot of people compare that with the purchase price of the property itself, but in reality, I didn't purchase these homes in cash. I financed them. So the money I really truly spend is not the purchase price total, but the purchase funds. So if you figure out how much of gain I appreciated, then equity divided by the purchase funds, that came to 260%. And that's the wealth I built over 8 years. Now income gain, the purchase price the same and purchase funds are the same. But this time, the total rental income I got from those 8 properties over 8 years came to $777,476. And the mortgage payment I made up to August of 2020 came to $543,120. And I spent $86,242 in repairs and renovation for all those 8 homes. So the net profit, I deducted total rent income, mortgage payment, and repair renovation costs from total rental income. That is my net profit, $148,114. This isn't too bad, but in comparison to the capital gain, it's not that very much. However, as I own and keep these properties, income gain also grows over the time. So eventually net profit will keep going up. I made these numbers in August of 2020, last year. And when I check it now, that my husband tells me that we have a cash flow about $8,000 because of COVID. We refinanced many properties to appreciate the low interest rate. And some of the properties rent went up. So we have about $8,000 a month of cash flow. And equity has grown as well because we appreciated the gain of housing price of like 15% or so. So this is the explanation why the capital gain is more important than net profit. However, I said income gain also grows over the time along with the capital gain. So this is what I would like to share about the income gain side of the story. So when you purchase a property, say the property was $350,000 and I made a 20% down, which is $70,000. And then you finance the rest of the price, which is $280,000. Over the time, your property appreciates to $500,000. So capital gain is $150,000, right? And then you are paying the mortgage off with your tenant rent. So you have the payoff of $60,000. Now, the mortgage balance is $220,000. So the reason I said income gain grows over the time is this. You have 2 reasons or 2 ways to increase your cash flow. One is if you increase the rent as inflation goes up, say 3% a year. If you started your rent to be $2,600, and then each year, if you increase 3%, it comes to $3,015. So over 5 years, you have $415 more of monthly rent. That's one thing. Another thing is that I just explained that the property appreciates in value, but at the same time, your mortgage balance decreases. And say that 5th year, your mortgage balance has become $220,000, while your total property value goes up to $500,000. Then you can refinance your house again to make it to payment of $1,050 instead of original $1,336, even if the interest stays, say, at 4%. So that way, the mortgage payment becomes $1,050. So by the 5th year, you actually pay down. So you have 25 years of mortgage time left, but you can refinance to make it over another 30 years to make the cash flow bigger, because your point of this property is to create the income gain. That's something you can play around to make it that monthly payment is now $286 less. So the rent has increased by $415 and payment has decreased by $286. Together, that's $701 per month. Over 12 months, you gain $8,412 income gain. That's what I mean by how income gain also grows over the time. So you can imagine this is only 5 years, 10 years, 20 years. And then eventually, if you decide to pay off the mortgage, then you have a lot more cash flow than at the time of purchase. Do you have any questions from here? So at the time of purchase, you do not have to worry too much about income gain because it grows. But I typically recommend you, like I said in the beginning, that your rent is paying the mortgage payment and also the repair cost. That's the point 3. Now, point 2, property value does not go up if you keep it vacant, keep it rented. Vacant homes decreases in value. It's because if you keep a house vacant, it just cannot stay in good condition. It's almost like house has feelings. They get sad and they can't stay alone. So it just quickly decreases in value. It's very, very surprising. Also, the difference in the value, this is in place, it's a mistake. Difference in value, price, I wanted to say, between a moving ready home and not updated home. And minimal repair is just not enough. And this is the example of Dublin City School home that was purchased in 2002 for $258,000. And we helped to sell this home in 2018. If we were to sell this house as is, it was $280,000 in this condition. It appreciated, but you can see it's not that much between 258 and 280, right? While we suggested to spend $36,000 worth of upgrade to this house, and the picture is after the upgrade and also a staging. We sold this house for $400,000. So you can see the big difference between untouched home to renovated home. So therefore, if you could, over the time, keep up with the house, not just repair, but a little bit of upgrade as tenant moves out, that will pay off in your investment. The third point, how long does it take for your lovely house to get a tenant? So you might see a lot of advertisement or marketing saying this house gives you a gross 10% return or net 8% return. Does that sound good? It sounds good, right? But it means nothing if you do not have a tenant at closing. So gross means rent divided by purchase price. For example, if you're going to rent a house after you purchase for $2,700 and the purchase price is $775,000, you multiply 2,700 by 12 and divide it by the house purchase price, and that's 8.64%. It sounds pretty good, but this is not thinking about any cost at all. How about net? Net sounds more real, right? Okay, how is net calculated? Rent minus expenses divided by the purchase price. So that's more realistic, isn't it? If you are going to rent it for $2,700, and then property tax is $7,700, and then homeowner's insurance is $1,000, and say property management fee, repair fee comes to $2,592, and after that you divide that by the purchase price, that comes to 5.6%, which doesn't sound too bad, does it? If you do not have a tenant as soon as you close the house, that still doesn't mean anything, because say 5.6% house ideally, but you purchase the home and then you start to look for a tenant, and say it was like winter months or something happened like COVID and nobody was moving from Japan. What happens? You had 3 months vacancy and you're desperate. Now there's some tenant saying, hey, would you give us some discount? I would rent this house for $2,500. So you might say yes. And look at the number that significantly changes. 2,500 times 9, and property tax and insurance and repair cost. This stay the same pretty much because you still own the house, you have to pay tax, right? The homeowner's insurance needs to be there. Repair. Like I said before, when the house is vacant, it deteriorates. So it might need more than when you had a tenant, but I kept it the same. So look at the number now. It's in reality 2.98%. So we have purchased homes at the beginning when there is only 200 cash flow, but as long as there is a 10% of rent shows as a cash flow, my husband and I decided to purchase. Why? Because we purchased the home that already had a tenant at the time we made an offer. So this is much better than whatever the high numbers that you expect when you have a tenant in place. And if they stay longer, then that is better. And I'll show you in real numbers what happens when you have long vacancy. Finally, own 4 homes as quickly as you can. One reason is it's less stress, because if you only 1 or 2, and then your tenant moves out, then what do you think? Oh no, I have to make a mortgage payment. I have to do this, I have to do that. Maybe I have to give a discount. I need to put the tenant in as soon as possible. That's a lot of stress. But by the time you have 4 properties, then even if 1 property becomes vacant, it's most likely the rest of the 3 rents would pay for 4 mortgages. So that's less stress. That's number 1. But at the time, we purchased this Rings Road property, the number 5. So you can see the purchase date from Renfrew, McIntyre, Sutter, Winters 1, Rings Road. It was 1, 2, 3, 4, 5th house. We simply bought this house because it was below the market and it was a nice house. So I said to my husband, hey, this is selling at a good price. Do you want to capture it? And we said yes, because by then there are 4 properties we had, all of them occupied, and we had a space to play. Just because it was a good price, we purchased it. But look what happened. This house was vacant for 7 months. It was a larger home and it was a good school district, but we couldn't find any tenant of that size was interested in moving into this house. At that time, we were not thinking about dropping the price. And so we kept that house vacant for 7 months. And then eventually tenant moved in. After that, we've had tenants. However, this number, so we purchased June 2016, and this number is August of 2022. 20. In 4 years, we still couldn't catch up with the rent income. It's still showing minus cash flow. But the reason own 4 homes as quickly as you can is this. Until I created this chart by property by property, I did not realize that Rings Road is losing so much money, to be honest with you, because other properties, when you see your bank account, there are money coming in and there's money left, and we have no problem making the mortgage payment or repair payment. So I didn't even think that we were losing money. So that's one good reason that we didn't have any stress from this Rings Road's vacancy. That's the proof. And more properties you own, you have more equity to pay more properties is another reason that instead of you try to own one and keep paying down till you feel comfortable to buy 2, quickly own 4 works because of this scheme too, that when you wanted to purchase more homes, in this case, we paid down to make the cash flow bigger. But once the house you purchased for $350 becomes $500,000, there is another way to create more cash. And this will be explained in the next meeting. But here you go. Because your house is appreciated to $500,000, now you can get refinancing up to $400,000, right? So that means that your mortgage is $400,000. That's 80% value of the house. And then your balance of loan is actually only $220,000. That means when you refinance it, you can make cash for $180,000. By refinancing it, you're creating the cash for $180,000. Now divide that in half and put that as a down payment for 2 houses, and you can buy 2 homes. So that's another reason why I'm saying to own as many as you can quickly, so you can appreciate more property values and you build equity so you can purchase more homes to be where you need to be. And then the money and appreciation and equity of the home start building your assets. Now, I talked about keep it renting and then keep no vacancy. So how do you do that? And that's is our company's business model. So when I first became a realtor 10 years ago, there were a lot of Japanese expats coming to work for Honda or Honda suppliers. There were not originally no rental homes in Dublin City School where most expats prefer to live. So therefore, when they are looking for a house, I show them houses for sale. Once they decide that they want to live in that house, because of their assignment is 4 to 5 years, and they have a housing allowance paid by the company, we look to the investor clients who would be interested in buying that house for a particular tenant. Then we had that help the investor purchase the home and tenant moved in as closing. This has been our business model. And as a result, I'm explaining what I'm explaining. I learned from actually the practice of it. Well, thank you very much for listening and watching. This is my today's seminar about no risk real estate investment.